In this week's video, we're going to be taking a look at why I believe UK house prices are going to continue to fall throughout the rest of 2023 and also for the entirety of 2024. So despite some of the recent headlines talking about mortgage rates softening, just like the one in front of us, and also headlines about inflation coming down, you could easily be forgiven for thinking that everything is going to be absolutely fine. The truth is, these are just minor increments in what is a much bigger problem for the UK economy and the UK housing market. And in this video, we're going to go over all of the things that are contributing towards the crash that we are seeing playing out and what we've seen over the past 12 months. So we know we're down 5% already, and the rest of this year and 2024 is going to be very, very grim for the UK housing market. So the first thing I want to take a look at is the actual mortgage time bomb. So rather than worrying about whether mortgages have come down from 6.5 to 6.2 average or something like that, I want to have a look at the size of the problem that is sitting there waiting for millions of people. So all of the Bank of England interest rate hikes over the past year or two have yet to be fully felt by all of the people. And this graph in front of us from The Guardian illustrates very well how much of the pain has been felt so far versus how much of that pain is to come. So as of making this video, it is September 2023. So we're probably somewhere around here. So just over 2 million people have felt the pain of their mortgage rates going up. And remember, the ones that remortgaged back here would have been on slightly lower rates than the people that are remortgaging at the moment. So I think as of June this year, there's still 800,000 people to go. So as of September, there's probably still 500,000 people that are going to be remortgaging throughout the rest of 2023. And then in 2024, I think we've got the actual statistics here somewhere. I think we've got 1.6 million. So here we go. According to the figures from UK Finance, about 800,000 fixed mortgages will expire before the end of this year. And this article was from June, so that's why it's less now, with a further 1.6 million coming to an end in 2024. So when they say that mortgage rates are coming down and they're softening a bit, what they're actually saying is all of these 1.6 million people that have got a remortgage next year and probably about 500,000 that are still to remortgage this year are just going to see their mortgages go up very slightly less than the huge increase that they are expecting. So most people are going to see their mortgage payments go up close to 50%, give or take, depending on the deal that they can get. And mortgages coming down a small percentage at the moment is going to have very, very little impact on that. So we are sitting on a mortgage time bomb. Only half of that pain has been felt. The other half is to come. And remember, it takes time as well from these mortgage rates going up to people to completely run out of savings and to really start feeling the pain, and for that to then filter through into forced sales, repossessions and arrears and stuff like that. But some of the early signs are already here, with the Financial Times reporting that UK mortgages in arrears jumped to a 7-year high. So a Bank of England survey shows a 28.8% increase compared with last year, reflecting a sharp rise in borrowing costs. So we know that mortgage arrears are increasing. We know there are over 100,000 people every single month coming off historically low rates of around about 2% to 5% plus interest rates on their mortgage. And this is only going to continue to build over the rest of 2023 and into 2024. We also know, we don't know, but it's very likely that the Bank of England isn't quite done yet. So there's another meeting in 3 days' time. I think it's the 21st of September. And they are expecting possibly another quarter-point hike at that stage. If they may pause it, I don't think they're going to do half a point. If they pause, that may be a temporary thing, and then they may carry on at the next meeting. It's all going to depend on the inflation data this week, seeing what that says. And with some of these things that I'm looking at the moment, I think we might see an unexpected figure, which might throw a right spanner in the works for the Bank of England. But we'll see how that plays out. So there's still potentially pain to come from the Bank of England. And if the Bank of England keep hiking rates up, it's going to be very difficult for the markets to reduce those mortgage rates any further. So 5% may be the best that it gets at the moment. Inflation is still a big problem. Yes, it is clearly coming down when you look at it visually. However, core inflation is still unchanged at the moment. So at the most recent report, core CPI rose by 6.9% in the 12 months to July 2023, unchanged from June. So that is one of the things that the Bank of England is worried about. If core CPI was actually coming down as well, then I think a hike at the next meeting would be less likely. But overall inflation coming down with core CPI going up, plus I think we've got here as well services inflation. Where are we? Services inflation actually went up last month from 6.3 to 6.5, and over 60% of the UK economy, the GDP, is built on services. That shows why services is a huge problem for inflation in this country, as we are a services country more so than a manufacturing country. So although headline inflation may seem to be on its way down, core CPI and services inflation are very much real problems for the Bank of England. And on top of that, we also have wage inflation. So we know since basically the mid-2021, so for the best part of 2 years, people in this country have been getting poorer because inflation, so there the prices line, has been outstripping wage growth. Now, the ironic thing now, as wage growth gets to this 7.8% and starts to cross over inflation, although it looks like inflation is starting to be defeated, wages going up is actually a problem for the Bank of England as well, as they don't want to get stuck in this spiral of wages going up, prices going up, and an infinite spiral is going to cause them real problem with inflation. So people have got poorer, and just when we get to the point where it looks like wages are going to overtake inflation, it could become a big problem for the Bank of England. And also, as I tweeted about earlier this week, you can follow me on Twitter. I'll put a link to my profile in the pinned top comment if you want to check me out after this video. I mentioned just because wages have caught up with prices, the wage inflation data doesn't take into account income tax or national insurance. So most people are still losing a combined 30 to 40% of their income to income tax and national insurance. So you're nowhere near parity yet. We're still well away from your actual take-home pay overtaking prices. So that's something to keep in mind as well. People in the UK, their economic situation is far from recovering at the moment. And to see what sort of damage this has done, £1,000 just a few years ago in 2020 is now £1,203. That's over 20% inflation, cumulative inflation over the past few years, all in a time where people have seen their mortgage payments increasing and their rents increasing and their real world wages going down. And it doesn't look like inflation has truly been beaten yet either. If you take a look at oil prices, and if you remember, oil prices going up is one of the biggest causes of inflation, as it increases the cost of almost everything from transport to production, and then that filters through to wages and the cost of goods to us to actually buy. So oil going up is pretty much always a leading indicator of inflation. And when inflation really kicked off about 18 months, 2 years ago, you can see oil prices had shot up sharply, especially just after the start of the war. And they've been falling ever since. So this is when there was a lot of the wholesale buying going on, when people were talking about energy prices were going to be high last winter. And then things have been softening. So that's why they were saying that energy prices are going to be coming down. And now we've seen this strong reversal. So since the start of July, let's measure this. We can see, let me drag this over so you guys can see this a bit bigger. We are looking at oil prices have gone up 32%. Now that potentially is going to filter through to the cost of materials, to the cost of fuel, to the cost of goods, etc. So saying inflation is done just because it's on its way down, I think is short-sighted, and this potentially could be the early signs of a second wave of inflation, which we may not see fully filter through to kind of the stats that we get published in the UK, maybe for quite a few months, as there is always a lag between the cost of oil going up and that filtering all the way through to the bottom where we're actually buying goods, products and services. We're also seeing the GBP, so the pound, is weakening. So ever since Truss's famous or infamous mini budget last year, the pound has been recovering. At its low point, which was the end of September last year, we were almost parity with the dollar, and we recovered to £1.30 or $1.31 to the pound. But recently, we have been falling since the end of July, and if we measure that again, the pound is down nearly 6% against the dollar. So if oil prices are going up and the pound is getting weaker against the dollar, the UK is primarily an import country. That means the cost of our goods and the cost of our imports go up. That can only spell bad news for inflation. So we know we have this huge mortgage time bomb. We know that inflation probably isn't defeated yet and has the potential to return with a second wave. And we also know that the UK economy is going sideways. It has ground to a halt Last month it shrank 0.5%, which basically reversed what happened, the increase that we saw in June. But for the past year, if you look at this chart here, the past year, GDP is zero. We have no growth. Let me hide the webcam so you guys can see that properly. We have no growth. We have the COVID drop here, the COVID recovery, and then we are sideways. Absolutely no growth in the UK. And remember, this is during a time where as well we printed hundreds of billions of pounds and gave it to the UK public to spend. Net migration last year was like 600,000. How can you have 600,000 people come to the UK, print hundreds of billions of pounds, and yet still see absolutely no growth in GDP? I think that just underlines the weak economic position of the UK, and this is underlined by the latest manufacturing PMI survey, and we can see the lowest reading basically since the global financial crisis, providing you exclude the mini COVID dip that we had there. So that is a very negative sign for UK manufacturing and the health of the UK economy. So we know that mortgage rates, the mortgage time bomb is sitting there. We know that inflation hasn't been defeated. We know that the UK economy is an absolute mess and is seeing zero growth. And we already know that house prices are down 5%, so 5.3% if you go by nationwide, slightly less if you go by Halifax. And the latest report from Rightmove is showing that 36%, so this is the most important piece to take away from the article that was just published this morning, 36% of properties currently for sale have had a price reduction, with an average reduction equating to 6.2%, which is just over £22,000. And anything that's selling is going to be at a level below that as well. So even our most recent up-to-date indicators are now painting a very, very grim picture for the UK housing market. We know house prices are down. We know that asking prices are falling. Sellers are starting to get realistic. Maybe sellers are starting to panic a bit as well, and they're starting to reduce their prices. Now, the actual headline figure, which you may see published in the news, is that year on year, asking prices are only down 0.4%. But always remember, that only applies to new listings. What is more important is this 36% of properties on there have seen substantial price reductions. And then the final two pieces of information for the housing market. This is mortgage approvals for actually buying houses. So this isn't just remortgages. We can see that is falling sharply. So people have very little interest in going out and buying. So the market is going to start to grind to a halt. And when you combine that with an increasing supply of listings, if you're going to use a supply and demand argument, that is all you need. Less people buying and the number of listings increasing. And then the final piece is the latest RIC survey. This is their house price balance survey, and this is posting again the lowest reading since the global financial crisis. So when you add up all of those metrics, I think it's very, very difficult to make the case that house prices are going to go anywhere but down over the rest of 2023 and into 2024. Now, if you're wondering how big I think this crash is going to be overall, I'm going to pop up a video in front of me now, and I'll see you guys over there.